Good to check on the markets this morning. Joining us now from the CME, Bob Iacchino, Chief Market Strategist at LotusBrokerage.com, and from BNY Mellon Wealth Management, Director of Investment Strategy, Chris Sheldon. Bob, what are we going to do today? Yesterday, how do you view it? As just an oversold bounce, all happening in one day, or the start of something?
Well, somewhat. You know, unfortunately, the
those were two different things.
Well, I'll give you. How about I give you an answer? How about I give you an answer on each one?
All right. Is it actually just a bounce back, or is it the start of something good?
I don't believe the equities are starting something good until the S&P actually gets above 1185, and I don't believe it's anything bad until we get below about 1032. Okay. And I know there's a wide bands, but that's what happens in the trader's market, and that's why I say somewhat. Yeah. This is not an investor's market. This is a trader's market. Even the longer-term hedge funds and mutual funds are acting more like traders by keeping more money in cash and borrowing less to trade with, or invest with, rather, than they've done in the past. So yesterday was a short-term bounce within a trader's market. It could last through today, it could last through tomorrow, but it doesn't feel like the start of anything new to me. Having said that, I'm still keeping with my position that we're going to be up anywhere from 9 to 11% by the end of the year. Different question than what's going to happen today. Yeah,
why isn't it the start of something? If we put Europe and the travails there behind us, and we start thinking about the U.S., maybe this is, a lot of people say it's typical to pause at this point in a recovery. So that would seem to indicate that maybe you should get on board. But then the other side, Bob, is the Alarian, Mohammed we had on yesterday, the structural problems that are different this time, making it a new normal, making unemployment, it's going to stay high for a long time, hurting the consumer and hurting growth. Do you come down on one or the other?
Well, I do. I mean, I was listening earlier when Michelle was talking about bond yields versus the top 30 S&P stocks, and the interesting part is that with traders involved, rather than Main Street just tends to buy and hold, collect their dividends, and hope that over 15 years they make money. But with Main Street having the fear that they do, and quite frankly not having jobs yet, you're looking at more of a risk-adjusted return, which right now the perception is, not saying I agree with that before Michelle gets upset, the perception is that the equity market...
She's an aggressive woman. That's what Byron
I mean
Ween
that with all due
it.
respect and affection, of course. But all I'm saying is that risk-adjusted return in the treasuries may look more attractive to people right now. The equities may provide a dividend payment, and they may provide a little bit of upside this year, but the risk of a 50% downdraft is obviously still in the market's mind, so risk-adjusted return could be less.
2.9 is awful for 10 years. I'd rather have it in my mattress. Chris, what about you? How do you explain that?
Well, I think one of the things that clearly happens, in addition to what Bob says, is that people got so fearful of that double dip, and we came off a terrible, terrible quarter with just a relentless flow of bad news, that all of a sudden we get into earnings season. It looks like there might be a bit of improvement there, and I think people realize maybe they overread that double dip case. So I think the long-term metrics may be there, valuation and dividend yields, but I think Bob is right. It's going to take time to work through some of these things that may or may not happen.
So in the back of people's minds, there is still the fear of another 20, 30, 40% drop in the averages?
Well, I think because that's what we just came off of. So I think that looms very large.
1932, all this talk about, you can superimpose one chart on the other, and but in reality, if the S&P earns $80 and you look at dividend yields and then you compare that to 10 years under 3%.
Yeah, and I think I agree with you. At 3%, there's a lot of stocks that offer some attractive prospects.
And yet people are buying the 10-year. That's the problem.
That's what I mean.
That's the problem,
Joe. They might be lemming. They might be sheep.
Are true,
they don't know anything.
They choose the 10-year.
They don't know anything.
Why?
Though. They don't know. They're living in the last year and a half things that could never happen, and they're saying it can happen again.
I vividly recall Steve Leisman sitting here years ago saying, if anybody out there is buying the 10-year with a 4% yield, would you please send me an email?
Right,
no email. We don't know it was the Chinese, but
I remember Jimmy Rogers. In his lifetime, the long bond will never fall below 6%, ever, in his lifetime.
You know what? If I could, guys, we do have a secondary market. I don't think anyone is looking at that yield and saying, over 10 years, I'm going to earn that yield and I'm not going to touch it.
Oh, I don't so you sell your $1,000 bond for $850 in 2 months. What good is that? That's not.
Well, I mean, once again, it's a perception of a risk-adjusted return. Remember what the age group of the majority of people in equities are, and whether they feel they can handle what happened a year. I'm not saying I agree with them. I think we're up at the end of the year, but that's the perception.
All right, Chris, you had the last word till Bob had the last word. Anyway, thanks, Chris. See you guys later.